Everybody, this is 𝙁𝙁𝙀𝙀, your host with the Freedom Report. It is a Friday, September 27th, 2024. This is the episode that gold and silver bugs have been looking at and waiting for a very, very long time. We've been talking about the breakout in gold. Now we've had a breakout in silver, and the miners are starting to move out. So now we have a confirmed last final stage of the bull market, which actually comes into two parts. Right now we have the paper price breakout, which will eventually lead to the physical price breakout and the separation of the physical price from the paper price. We're not quite there just yet. There's some other things that need to happen, but we are into the breakout on the derivatives market because everybody's coming in and going long and forcing that price up and breaking the backs of the bullion banks and those that are buying through the bullion banks to short the gold and silver markets. And we'll get into that. You guys are going to love this. We're going to start off with the Goldman Sachs report that I alluded to on Tuesday's video, the economic report, and that came out on the 23rd, I believe that was Monday, on Zero Hedge, about how Goldman Sachs broke down the divergence of what's happening in gold and silver. We'll talk about the ETFs. We'll talk about the COT report. We're going to talk about all of that. Plus, I got more data for you beyond the Goldman report. And we are officially in the last stage of the gold and silver bull run for this mega cycle. This mega cycle going back a very long time, dating all the way back really to 71, when we started the commodities markets and removed gold off the dollar and let it freely trade, but really back to 1913 with the creation of the Fed. That's how big of a cycle this is. And this is the big one. This is the big mama that's come again in two steps. One, the paper war, and then the physical price separation. We've already had the physical war for a long time. The paper suppression kept it down. And now we've got the paper war breaking out, which is going to free gold and silver to where you're going to see multiples of price. Now, this process is going to happen over years, not days or months. But the fact is, we're past the point of no return. We're no longer in a market in which that short paper controls gold and silver price. And we'll get into that. Let's start with the Goldman Sachs report here on Zero Hedge. Thanks to Zero Hedge for doing this analysis for us. This has been all the rage all week long on gold and silver channels. So we definitely wanted to get into it. Something remarkable happened to the price of gold back in 2022, according to the article, around the time of the Ukraine war. Having previously tracked gold ETF inflows to the tick, the price of gold suddenly disconnected and exploded higher, even as paper gold, as some call it, slumped. We showed this for the first time back in April with the following chart, which showed a clear decoupling between paper and physical gold in 2022. And here you can see the gold price and the gold ETF holdings. Now, they're characterizing paper gold as only ETF holdings. That's a little bit off. The paper price is also the London OTC market. It's also the COMEX derivatives. So, but what they're really saying is the ETFs separate from the derivatives market, which means the players are going different directions. Let's talk about that. So the gold price in the derivatives market went up while the ETF holdings went down all the way down to 2024. Gold price versus ETF flows. So you have the gold price going up, ETF flows going down, but now the ETF flows have ticked up. Remember how I was saying that retail, U.S. retail in particular, that invests in GLD in gold and SLV in silver had not broken out just yet, hadn't broken out. So you could tell, and also with premiums have been lower, with the exception of a couple of mini breakouts like in American Eagles. The premiums have been lower for a long time, really dating back to after the pandemic and the shutdowns, where we restarted the economy, and gold and silver price, everything seemed normal. Gold and silver price began to fade. Retail interest began to fade. Well, now it's broken out this time, but the breakout is a lot bigger. And it's not just coming from the U.S. market, although the U.S. retail market has woken up just as of very, very late. And I don't think it's just a U.S. retail market. I think it's around the world. In any case, let's get into it. This is the chart I really want to show you. And I'm going to quote them, Zero Hedge's writing here, which brings us to the weekend and yet another remarkable observation. While gold did correlate very closely with ETF holdings in the years prior to the Ukraine war, since then gold has completely lost all correlation with ETF holdings and instead has been correlating tightly with another data series, managed money. We'll get into that in a sec when I look at the Commitment of Traders report, which is right here. I'm going to explain this. What they're talking about is the ETF holdings, which signifies retail demand, has broken out or has separated now from what you saw in the derivatives market. So retail is fighting it. Some flows into the ETFs are fighting it. Now, again, this isn't the second part of the final stage because you have to have that collapse of the derivative market before you can have free gold and silver, but it's an important part of it. It shows here, regime 1, gold price correlates with gold ETF holdings. This is the green. Until start of the Ukraine war, when U.S. weaponizes dollar and central bank unleash a gold buying spree. Well, the central banks, yes. Remember an episode I had in the last couple of weeks where I said the central banks had buying more gold since the pandemic, since 2020. What do central banks do when you have a crisis? They buy gold. That was last Thursday's report or last Friday's report. That's what they're saying here. Regime 2, gold price now correlates with gold managed money hedge fund traders. So yes, the hedge funds, managed money financial houses have gone hard gold north and hard silver north, and we'll show that again when we get to the CFT commitment of traders report. Again, not the ending of the derivative market, but the rest of the world is fighting the derivative market, and there's been a change in the derivative market such that all of the paper shorting by the bullion banks is not suppressing those prices anymore. And remember when I showed you it broke out on the chart in gold? We'll show you that here in a moment. Well, now it's broken out in silver. They say here at Zero Hedge, of course, it's not really just hedge fund buying, as we first explained back in 2022. Central bank, mostly the Chinese central bank, buying was the biggest driver behind gold's decoupling with paper holdings and prices. Again, yes, but the derivative market is also paper. So they don't do a great job of separating the different paper market outs here, but we get the point. People are coming in, a lot of foreign buyers are coming in, big buyers are coming in, and they're basically wrecking the COMEX derivative market, and that shows up in the ETFs, which because you don't have a settled physical price universally around the US, it's all determined by derivatives. Goldman is looking at ETFs, which is another derivative against the paper, okay? And again, that's the final stage of that collapse of the paper market before you have the big breakout. So we're not the big breakout yet, but we're getting close because one paper market, which allows them to intervene, is fighting against the other paper market. It says here, but where things get interesting is that ETF flows are now turning positive, and when combined with continued central bank buying of the physical gold, combined with record Indian gold imports of the physical gold, combined with unprecedented demand for physical in the US, which I dispute because that's not really true, but it's okay. We're not going to argue on that. No wonder that gold is hitting new all-time highs day after day. The reason I know the physicals aren't is because I look at premiums for wholesalers around the country, and they haven't blown out yet. Now there's been a little bit of interest, but right now I can go to my wholesaler and get silver and gold really cheaply above the spot price from a wholesale perspective if I wanted to, as a retailer, sell it. So we're not quite there in the physical demand yet. So they're a little off in this report, but they're getting close. And we're at that first part of the last stage of breakout. It says here, quote, gold prices traded at fresh all-time highs on Friday, closing well above the $2,600 an ounce barrier. The rally in gold seems unstoppable at this point, and resets on the all-time high are becoming frequent occurrence. This perhaps comes as no surprise, given that the Fed wrong-footed many economists to start the easing cycle with a supersized rate cut, even as growth has remained strong, inflation above target, and federal deficit at eye-watering levels. Yes, what they're saying here is the Fed came in at 50 basis points instead of 25 in their cuts, and people had priced in 25, and that was signifying that the Fed really felt, because they did 50 at once, not consecutive 25s, but 50 at one time, that they really felt the economy was worse, looking at the numbers, which we've been screaming at for, I don't know, about 15 years, but specifically since COVID started, since the pandemic started, that, oh yeah, situation's getting worse, The Fed finally is easing now. And that's a signal that the Fed knows that the end of this dollar system is coming. Because remember, they get up to about 5.5% to deal with a recession, and they're already cutting. So that's an acknowledgement we are in the recession, even though it hasn't been officially called. When you see the Fed cut, when they're sitting at 5.25 to 5.5, their range, and they cut 50 basis points all at once, then that lets you know that they know that they're in the recession, even though the government won't allow them to call it. We've been in a recession. We know that from the McKinsey indicator. We know that from the yield curve inversion indicator, the 2 and 10 year. We've been calling a recession here for a long time. Going down a little bit farther, there's one other thing I want to show you before we jump on. Two other things. Cumulative flows across gold ETFs. And this isn't just GLD. This is world ETFs, which I'll show you here in a minute on a chart, has been going up since August of 2024, after it kind of come down. Well, actually, I would say since July. And remember in the middle of the summer when I said, you know, we're not going to have the normal summer doldrums in the price. We're starting to see inflows. Now, it wasn't all into the retail market here in the US. Some of it was Most of it was overseas, but we started to see that price pop up about a month before we normally see it. That's the reversal here on this chart that I've been documenting all summer. Oh, and they talk about, here's what happened. As Quinn observes, prior to September Federal Reserve meeting, I'm reading right up here, speculative positioning in the silver futures surged and managed money dominated. We'll show you that in the commitment of traders report here in a second. With producers reiterating a tighter physical balance, lower U.S. real rates and the dollar served as an incremental catalyst. What is real rates? It's the difference between interest rates and inflation. It's the rate that you get in the market. And when you have that divergence, that causes gold to surge. And then silver. After the Fed delivered a 50 basis point cut, silver price extended higher. However, flow indicators were more mixed. Here are some observations from the Goldman trader. Quote, prior to the September Federal Reserve meeting, speculative positioning in silver futures surged per commitment of traders. Combined managed money, other and non-reportable net length jumped 2.6 billion from September 10 to 17th, 1 week, and the price gained 8%. For context, the increase marked the second largest over the past 5 years. New longs were the sole driver. Managed money purchased 2.3 billion. Since late 2019, managed money silver buying exceeded 2 billion in only three other instances. With producers reiterating a tighter physical balance, lower U.S. real rates, and the dollar served as incremental catalysts. So they're basically saying what they're going to say here, and I'm just going to summarize for you. There's enough room, okay, for the shorts to continue shorting and having the physical to back that up for people who claim delivery. But they only have so much before that reverses. And Goldman thinks that essentially we're closer to that reversal where we have the physical short squeeze on COMEX in both gold and silver. Let me say that again. Goldman believes we're really close to the point at which the gold and silver squeeze occur in the physical to where you can't just continue dumping paper shorts to keep that price down. Eventually, you're going to run out. And what did I talk about last week with the London OTC market and David Jensen's report showing us in that data that London had drawn down, I think, gold 8.1% just in the month of August. So we're seeing stress of physical availability in London, and Goldman is saying we're about to get stress of physical deliverability in the COMEX here in the USA. Here's the commitment traders report. Now, what he's saying in gold and silver, we'll start off with gold down here. This is gold. This is as of September 17th, it's about 10 days ago. Remember, old data, about a week old. It's the way we get it. Look at the swap dealers' positions. They had to go 303,000 short to 45,000 long. That is about a 6.5 to 1 ratio to keep gold suppressed. They're about 6.4 to 6.5 short to long. And so if this market continues breaking the upside, one of these banks putting in these trades or their customers funding the trades is going to go bankrupt, because you can't continue to go short and have that price rise. It prices you out of your shorts. And even if you try to roll to another month, you're going to lose money. Eventually, they're going to break. The system's going to break. Will it break this year? I don't know. But the pressure on the shorts is building on the COMEX. You can see here in gold. Who is the long? Who are the heroes of the story? Bidding up the price of gold. We'll look at 241,000 long managed money, 25,000 short. Now, that's not as high of a ratio as the swap dealers, but if you add in the other reportables, which are the smart money, family offices, things like that, a little bit smaller traders than the hedge funds, but still financially interested, wealthy individuals and businesses, they're 127,000 long to 34,000 short. So they're about 4 to 1. So you add all that together and they're bullying up on the swap dealers at a higher rate. And the only other thing that's keeping the prices down are the producer merchants hedging downward price. Although as the prices continue to rise, I fully expect the producer merchants to drop some of their shorts. Why would you need that many shorts if the price continue to rise? You don't need to hedge it down. If you're making money, the miners are making money on that, the short hedging will come down eventually. So producer merchants, I would expect in the next 2 to 3 months leading into December next year to release some of their short pressure. And that puts almost most of the short pressure, the vast majority of it, on the bullion banks. And like I said, eventually either one of these banks or the clients they're trading for is going to go bankrupt, because the long pressure is there across the big financial houses and the rich family offices and traders. Going to silver, similar thing, more than 1 to 1 short on the swap dealers. But if you look at the managed money, they're beating up on them almost 5 to 1, about 4.5 to 5 to 1. And the other reportables about 4 to 1 plus. Again, you have a lot of short pressure right here with the producer merchants at 38,000 contracts. But again, I expect as silver price, now silver is a little bit more susceptible to cost pressure because silver is not as far above its cost to get out of the ground as gold is. So I expect the silver producers to hold some more of those shorts for legitimate hedging of the product they're going to get out of the ground in the next 3 to 6 to 9 months right now until silver begins to separate again. Remember, gold separated first. So the pressure on short gold in the producer category should come down as they're making money first before silver, because silver just started to break. We need more room between that price of getting silver out of the ground and the price that you're seeing when they sell it. And it needs to sit there for a while before the silver shorts remove their pressure. So the swap dealers have a little bit more air cover, if you will, a little bit more help from the producer merchants on their shorts in the market for right now for silver than they do gold, and probably be there a little bit longer. But eventually the producer merchants, as gold and silver rise, are going to cut their shorts because they're not going to feel that gold and silver are going to go down. They're going to be making profits just on the sale. And eventually that's going to leave all the short pressure on the swap dealers. And they're going to have to put more and more and more and more paper on it, which means when it breaks, it's going to explode. That's the dynamic you're going to see. You're going to see swap dealers continue to put shorts on, either for them, the banks, for their own accounts, or for their customers. And eventually that's going to break. You can see that in the data. And that's what Goldman's talking about in this report, in this part of this report. Now let's talk about the ETFs. Now ETFs is sort of a rough proxy for retail demand. It's a good proxy, but you also have to look at premium rates on the physical. Now premium rates on the physical haven't exploded yet, but I've heard that the wholesalers are getting a little bit tight on some of their gold and silver physical products. And as I look at my wholesale list, some things are starting to kind of come down a little bit. And that is the supply chain. It comes from the mines to the mints, to the wholesalers, and then to the retail public. So as we see those premiums start to explode up, that means we're having physical silver shortages. I haven't seen that just yet. There's been a little bit of movement, not much. But the other proxy for that is the GLD and SLV. Why? Because not everybody buys gold and silver physical. Some people get in ETFs because they have fund money. They have money that they have in their broker account. They have money through 401k, even though this isn't big in 401k. Some may have exposure to it through some mixed funds and things. And so this is like money in the system that people will allocate to gold and silver, which is not actually physical. A lot of the millennials buy the GLD and SLV because they like that they can punch it up on their phone and get into gold and silver without buying the physical. Now, I think that's going to change. Once this breakout gets more legs, what's going to happen is the millennials are going to switch from GLD and SLV to the physical, just like my generation, the Gen Xers, did it back in 2009 to 2011. And we're going to create another generation of stackers. And oh, by the way, the millennials are the largest generation on planet Earth, over 2 billion of them. And their ability to move a market, even though they don't have the most wealth, when they move in sync, they can move a market almost by themselves. They're huge across the world. All right, looking at GLD, the last 3 months, 14% increase in holdings. iShare Gold Trust 14.6, VanEck Gold Miners 22.7, SPDR Gold Mini Shares 14.64. You've seen that there's been investment in all of these different ETFs. Let's look at GLD, the most popular one probably in America right now, to look at the American market. You've seen increased inflows in GLD here for some time, dating back to September of 23. This mimics the gold price breakout. So retail is contributing on the ETF level, not the physical. That's why the physical is not that strong and premiums are a little bit lower, but you're getting a little bit upward price pressure on gold, because it does signify gold demand. And supposedly GLD and SLV, when they get investment in, are supposed to actually buy the gold and silver, even though we think that some of it's rehypothecated or leased out. In other words, it's part of the Ponzi. So just if you put money into GLD or SLV, we were saying this about 4 years ago during Silver Squeeze, if you just invest in GLD or SLV, you're not going to get that run on the physical stocks, because they, according to prospectus, they don't need to match it 1-to-1. And then we think they're rehypothecated, or they're reselling it to a second party anyway from those funds. There's evidence that they may have been doing that in the past. We've examined in the past. So if you just put money in GLD and SLV and you're part of the millennials, that's not going to break the market. That's not going to suck all the physical. It'll suck some, because they do have to have a reasonable amount of silver and gold backing, but not 100%. We know that. And they may release it out to create, what you may be doing through GLD when you invest in GLD and SLV is putting money into those funds, and they release it out, the physical that they take, and put it right back out in the market. So if you really want to affect higher prices, you go buy the physical and take that physical out to where they can't use these funds to do that. Hopefully that makes sense. Here's the overall silver ETF list. SLV is up 10% in 3 months. SIBR, the Aberdeen, up 10%. SIL, the Global X Silver Miners ETF, 1775. SILJ, those are some minor indexes, but there you go. Those are the ETFs in silver. Those are all up over the last 3 months. Here's SLV specifically. Oh, I didn't get a chart for SLV. Here we go. Here's the chart for SLV. And it started to go up as of August of 22. So we've seen some nice inflow. Now, it's just broken out from where we were around the pandemic. We go to GLD as well. It's broken out way where we were from. See, the gold broke out more. Here's the pandemic high. And then here is the high now in GLD. So GLD investments broken out more. In silver, SLV, we just broke out. So again, silver lags gold in the breakout. Always happening this time. Now, here's the real gold futures price. This is what determines spot prices. Now we're going to get to spot prices. So let's break it up. Let's recap, because there's a lot of information going on. There are a lot of different markets. A lot of markets are paper. Some are physical. Most of what we're seeing here is paper, which affects prices. But the thing that affects prices most is a derivative market in the US, and that's on this chart. Okay, it's still a paper market. Goldman Sachs doesn't really, and Zero Hedge don't really make the correct distinction of paper to paper. The ETFs, the GLD and the SLV, and the derivative markets are all a form of paper. And you're seeing a divergence between the two, but they're still paper. So that's why I say we're in the first part of the breakout, not the second, where the physical demand goes absolutely bonkers, because people are using paper against paper until people figure out that they need to break the paper scheme to really get the last biggest super boost in the gold and silver price. That's what we're going to deal with. But here's the derivative market. Here's the breakout. Now I've used Fibonacci. Let's just call these trading channels. So I graphed the low price dating back to about 2003, all the way up to the 20 high, during the shutdowns. And I took that and I graphed it out and said, okay, give me the trading levels. A Fibonacci is it's just levels, or trading levels at certain prices that people trade to. They're psychological levels. Every market, from precious metals to oil to whatever you're talking about, stocks, have these mental points that people use on the up and the downside to say, well, I'm trading to that target. If it goes beyond that target, it's a breakout. If it falls below that target, it's a crash. That's all this is. So they're just tranches. So we saw in gold, I graphed out about the 20-year price in gold, almost a 20-year price in gold. And I said, where we had this big breakout. This is the biggest breakout basically in history, if you look at it. So I looked at that and said, okay, since the tech crash all the way leading past the Lehman crash, all the way past the pandemic, the last 3 big crashes in the American market, I graphed that out and said, give me that range. And when it breaks that range, that is basically a 20-25-year breakout. And actually a 50-year breakout if you go back to the 70s. Okay. And that's where gold is. Gold is in that top stage. It's running. The paper market has not broken yet. But again, go back to the COT report. Look at this leverage in gold. Go down here to gold. They're having to short it. I mean, you're talking a huge amount. And the managed money and other reportables are on the other side saying, no, we're going to break you. Now, who are the managed money reportables? It can be foreign financial houses. It can be foreign sources of money. In other words, everybody's trying to break the derivative market. And that's why you see on the gold chart this breakout. They're trying to break derivatives. Some people are doing it through GLD and it won't work. You have to do it either through the derivative market or suck out all the physical. So at the same time, so the derivative market breaks, there's no physical to back it up. And that's why Goldman said in the report, we're getting really close to the point at which we have a gold and a silver squeeze in the COMEX market. Looking at silver, similar dynamic. You've got the trading ranges here, the resistance points, if you will, the Fibonacci's. And silver now is into the 3rd Fibonacci, dating back to the 70s. I took the price of silver 50 years, and we're starting the breakout. It's not into this tranche, or this level, or this level. Okay, once it gets to that level, you're talking about breaking the all-time high of silver, in which it could run as far as it needs to run. So we're a little bit behind in the silver breakout. We're not quite where gold is, but this is confirming the silver is firmly into that level where it's eventually going to be where gold is. And that's a confirmation of gold. When you look at gold, here's gold. Gold's all the way at the tippy top saying, I broke a 50-year trend. Silver's like, I hadn't broken the 50-year trend, but I'm following you, gold. It's a little yappy dog following the big dog. Now I want to talk about mining stocks here for a minute. Mining stocks are another confirming indicator that you have a breakout in the metals. When you have a breakout in the metals and it creates enough price surplus for the miners, you open up more mines start reporting more money, you started getting flow of investor money into the mines, and that drives up the price of the mining stocks. Look at the mining stocks on the GDX, one of the charts of the majors and a lot of the mids. Dating back to February, we've had a nice little this year. So it's been following gold slowly, and that's a confirmation they believe that the gold market is real. Why? Investors will put money into the stocks when they believe the gold breakout, the gold market is real. You're seeing that. There's profits being reported on income statements. The traders are seeing that they're throwing money into the stocks. The leverage or the speculative side for stock investors. What about the GDXJ? These are the juniors. These are the explorers or the junior producers, that kind of, mostly junior producers, but some about ready to produce, or some producers that have a bunch of additional stock that's not being produced yet. Let's put it that way. So not all of this symbolizes gold and silver coming out of the ground, but it does symbolize the smaller producers that will have, the marginal metal that we need to come out of the ground. And this has started a little baby breakout. Again, dating back to February, not as big as a GDX. This is the big mama stock breakout in gold. This is the small mama breakout in gold, and it's confirming. So we've had confirming signals. Gold price goes up, confirming signal. Silver price breaks out. Not quite to its last level. Silver hasn't really gone absolutely bonkers to its last level like gold, but gold's going, broke a 50-year trend. Silver's on its way to matching and then breaking the 50-year trend. It'll be some months probably before it happens. I said before, maybe up to a year, but it's going to happen. And then you have the confirming the mining stocks, the big mining stocks, and then the small mining stocks. And when that happens, what happens, Rob? Why do you talk about mining stocks? Well, look at what happened from 1979 to 1980. What happened in 1979, 1980? We had the big inflation. The government had to raise interest rates. There was panic in the market. Look at the return of some of these juniors in the market. Carolyn Mines, 1,700%. Mosquito Creek Gold, 971%. North Hair Mines, 233%. Lincoln Resources, 2,400%. Now, this is not the entire junior mining sector, but some of the names that were more highly valued, like some of the names more highly valued in the GDXJ, will break out like this when we get the last part of that gold and silver run. So if you're thinking about how do you leverage your gold and silver investment and get the most bang for your buck, you can go to mining stocks. Now, it's speculative. It's a little bit more dangerous in terms of its volatility, but it's a confirming signal. We're not quite there. That was a 1979 to 80 junior breakout. That's the type of return you're going to see when we get to that last stage of the gold and silver breakout here. Again, to recap, that was a ton of stuff. It was 27 minutes of just throwing data and charts at you. Let me sum. Goldman says the ETF have separated from the derivative markets, meaning there's an indication that people want more gold and silver. The derivative markets aren't broken yet, but there's signs that we could be coming to a physical squeeze on the COMEX in both gold and silver, which I've been talking about now for about a year-ish, year and a half-ish that this is coming. Now Goldman's recognizing it. You see global inflows into ETFs and gold and silver going up. You've seen the breakout in gold into its 50-year breakout pattern. 50. Since what? Since the dollar was taken off the gold standard. What does that signify? The end of the what? The dollar. What are we talking about? De-dollarization. The central bank survey saying we're going to drop our reserves in dollars. China now, there's reports that they're taking their dollar hoard and they're spending that. That's their form of QE. They're not printing, they're printing Chinese currency, but they're taking the dollar hoard now starting to spend. That's the last stage, because if China starts dumping their bonds and their dollar hoard, what's going to happen is it's going to crash the dollar. China doesn't want to do that as a last resort because they hold so much. So they're doing it as a last resort to save their economy, to pump up their economy before the big worldwide recessionary crash. You get what's going on? All these things are coming together at the same time. You have people warring in the metals markets. You have China dumping dollars in bonds. You have the gold breakout. You have silver starting its last leg of the breakout, which means the derivative market's breaking, because they're going, according to Goldman and according to what we've been saying, they're going to run out of physical silver and gold to where the shorts aren't going to matter and the market's going to break. You're going to have what they call like a force majeure, or an event at which they try to stop trading on the COMEX, and then it doesn't matter. Gold and silver are still going to run anyway, because nobody's going to take the COMEX or the London OTC market seriously. Remember last week we talked about the shortage of gold and silver or gold specifically in the London OTC market, silver's falling right behind. These are signs that this Ponzi scheme of selling the metal multiple times is starting to break because there's so much freaking demand. There's so much demand. It's bankrupting the world of free gold and silver. That's what's happening. And that's causing that breakout. And again, the last stage, which will confirm that we're at the last part of the gold and silver breakout before it tops and comes back down, will the miners start to break out, and they'll break out for a while. They may break out for 2 to 3 to 4 years even, and then they'll reach a peak. When the miners reach their peak and they start turning, they'll turn before the gold and silver come back down into some sort of equilibrium. All of this could play out over several years because we haven't had the worldwide crash yet. We still got some bank failures to occur. We've got some busted currencies that are going to happen. We've got some more regional wars that are going to occur. All that stuff has to happen. So again, this breakout is the paper war, the paper breakout we've been talking about since I've been covering this for 15 years and specifically on social media since 2019. That's the first part of the last stage of the gold and silver market. The last part is where the derivative markets completely break. Nobody pays attention to them. The mining stocks start their absolute meteoric rise. You can't find gold and silver at your gold and silver store. We're not there yet, but we're getting there. We're now in that final stage of the blow off top in gold and silver. But first, we have to have the economic collapses and all those calamities to where you have the final boom, the straight up move, the really big move where we're going to see what gold and silver really are valued at, considering all the money printing and all the lies in the data and all the things we've been talking about for years. So you guys are like, when's it going to happen, Rob? Guess what? The tide turned this summer. The tide turned this summer. And we're into the last few years of where it's going to go bonkers. So if you had not bought your gold and silver to now, this, and I've been saying this now for a year and a half, your last chance, your last chance, your last chance. The gold and silver market can turn down cyclical. You can have little pop, but I mean, the overall trend is going to be up for several years from here on out. You know, we're not going to, it's not going to come back down and stay down anymore. The world knows what's coming. The world is buying silver and gold that they can. We're going to run out of the physical and things are going to go nuts, and it's not going to be too long. We're at that final stage. So if you hadn't bought it yet, this is Last Chance Loon, ladies and gentlemen. This is it. You got a little while, but not long, and it's real this time. It's not like Silver Squeeze in I believe it's 21 January, February. That was an indication that we had some shortages and they had to cap the price. Remember, Rostin Benham came out and said, we capped the price at 30, saved the market participants, blah, 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 the integrity of the market. We had that on our channel. It was public. That was a sign of what's coming now. Okay, the signs are coming, but we hadn't had the whole physical blowout. Now we're starting to have that physical blowout and it's affecting the derivative markets, and those are all going to break. And then the last stage is going to be the big blow off top. Again, a couple of years for that to occur. But this is what everybody's been waiting for. Some people have been waiting for 50 years. Some of you came in 2008, 2009 in my generation. Gen X is when I got involved. The millennials started to come in when? After the shutdowns in 2020, 2021. They woke up when they didn't have the jobs and they experienced that. And they said, oh, I got to get into gold and silver. That's what's happening. And again, for people who think that Bitcoin and the cryptos are going to take over for gold and silver, that ain't what we seeing in the markets. Now, I personally don't think the Bitcoin has the same value as gold and silver. I think it's going to explode because there's going to be money going into that. Anything that's not the dollar that is considered an alternative currency, whether electronic or otherwise, is going to get a bid. Okay, Bitcoin being the leading cryptocurrency. But at the end of the day, remember Exner's pyramid, the central banker who assisted Volcker during 79 and 80, who is himself a central banker in other countries, who did Exner's pyramid. What did he put on bottom? He didn't put Bitcoin, he didn't put dollars, he didn't put real estate, he put gold and silver. Gold and silver are the ultimate financial asset during times like these, period, end of story. And we're now in that last stage. It has two parts. Remember, I talked about Silver Squeeze having two parts. One, people putting money into silver, and then that generation, the millennials, will switch to physical. Now we're seeing the lack of physical and the wars in the derivative markets. Okay, then it's going to be a physical war. And that stage 2 of the physical war has been occurring since 2021. And now we're in the final stage of the gold and silver blow off top, and that's going to be 2 parts. Part 1, the derivative wars and the paper wars, and then part 2, no more physical. That's what's coming. And man, we've been waiting on this day for a long time. And it has started. This is the beginning. It started middle to late this summer when I changed my opinion and said, we're not doing summer doldrums. Forget that. This baby's going to run, because I was seeing all this. And now we finally, have kind of put the picture all together for you. So on one hand, that's a celebration for people that have been PM bugs, gold and silver bugs, and supporters who've had it in their portfolio. On the other hand, if you don't have it, it's not a celebration, because you're not getting it cheap anymore. And there may come a point that at any price, nobody's going to sell to you. And it's not going to be that long. And that day is coming. So you're running out of time. But I guess good news for people who have been in these markets for quite a while, waiting to hear that information. You guys have a great weekend. This has been Rob Kientz with the Freedom Report. I'll see you again next week with the economic and the precious metals report.